From Bloomberg's Washington Bureau to our TV and radio audiences worldwide, I'm David Weston. Welcome now to Balance of Power, where the world of politics meets the world of business. On the brief today, Kevin Cirilli from Capitol Hill on day 3 of the open impeachment hearings, Bill Ferries on a big change in U.S. policy toward the West Bank, and Therese Raphael from London on the debate tonight in the UK general election. So, Kevin Cirilli, let's start with you. Day 3, what are we looking forward to?
It was remarkable this morning to hear these two officials testify publicly before the House Intelligence Committee. Alexander Vindman, who has worked at the National Security Council for quite some years, describing virtually his thought process when he was on that July phone call between President Trump and Ukraine President Zelensky. He says that he had no choice but to report that phone call directly to White House counsel because he knew it was political in nature. And then there was Jennifer Williams. She, of course, is a senior advisor to Vice President Mike Pence. She also described that telephone call as political in nature. And just moments ago, House Intelligence Committee Chairman Adam Schiff testifying, asking Jennifer Williams about how President Trump tweeted that she was a never Trumper. She said she wouldn't describe herself that way, David, but that she was rather never partisan. The White House continuing to push back against Vindman, against Williams. All of this comes just one day before Gordon Sondland's set to testify. Remember, he's the individual that reportedly was on the other end of the receiving phone call between President Trump when President Trump asked Gordon Sondland specifically for an update with regards to whether or not President Zelensky was looking into the Bidens.
Okay, many thanks to Kevin Cirilli, our chief Washington correspondent, now reporting from Capitol Hill. Now let's turn to Bill Ferries, because there's been some big developments actually in U.S. policy in the Middle East, particularly toward the West Bank, Bill.
Right. Yesterday, Secretary Pompeo announced that the U.S. would no longer view most of these settlements in the West Bank as illegal under international law. He said he was going back to a position held originally by President Ronald Reagan, but it's something that takes place in the context of wide international consensus that these settlements and their continued expansion are a hindrance to peace prospects in the Middle East.
And one of the things we heard right away from the area is this means this is the end of the U.S. role as a peacemaker on the West Bank with the Palestinians and Israelis.
Right. I think that's actually a continuation of that view from the Palestinian side, at least. They have long said, since early in the Trump administration, that they don't view the U.S. as a credible negotiator at this point. They've been opposed to the U.S. decision to move the embassy to Jerusalem. They were opposed to the U.S. recognition of Israeli sovereignty of the Golan Heights. This is another strike from the Palestinians' view against them and their efforts to reach some sort of a peace agreement with the Israeli government.
So let's go all the way from the Middle East over to Hong Kong, because there's a lot of elements involving Capitol Hill where we have increasing sentiment on Capitol Hill to really change Hong Kong's trading status. We heard Mitch McConnell, the majority leader, yesterday come out and say, Mr. President, you need to speak out about what's going on in Hong Kong.
Right. Majority Leader McConnell said the president should speak out on behalf of the brave women and men protesting in Hong Kong. We're expecting a vote in the Senate as early as today on a measure that would put Hong Kong's special trading status with the U.S. up for an annual review. And one of the big questions is, besides that direct impact, is what effect it will have on the ongoing trade negotiations that seem to have been drawn out over the last several weeks.
Bill Ferries, who heads up our National Security Conference right here in Washington. Now we go over to London, Therese Raphael, because there's a big debate, as I understand it tonight, Therese, over there in the campaign.
Yes, David. I mean, you have had debates in the U.S. for many decades, but they're relatively new here. The first real debates were in 2010, and tonight's debate is the first one in which the leaders of the two major parties have gone head-to-head. Boris Johnson goes into this debate, the Prime Minister, with a double-digit lead in most of the polls. So in one sense, he has the most to lose here. Jeremy Corbyn, the opposition leader, looking to try to shake up a campaign that really hasn't taken off for him in the way that it did in 2017, where he came from also a double-digit deficit to really narrow it and make the largest gains the Labour Party had seen since World War II. Although they didn't gain power, they denied the Conservative Party their ruling majority. So important debates. I don't expect that it will change much, but many people will be watching just to see how the two do against each other and on the major issues. Johnson will be trying to keep this very much on the subject of Brexit and his promise to just get Brexit done and move on to other things. Jeremy Corbyn will want to take the attention away from Brexit and discuss his promises, which include massive spending on public services, wide-scale nationalizations in the utilities sector, and other elements of a socialist program that is quite radical and that Corbyn is hoping will gain especially younger voters.
Okay, many thanks to Therese Raphael reporting from London. And now let's get a check on how the markets are reacting to today's top stories. Joining us now is Abigail Doolittle from New York. It looks kind of mixed to me right now, Abigail.
You're right about that, David. Very small moves for the major averages. Record highs nonetheless. And we did actually just recently have a headline on trade, the idea that the U.S. and China would try to reach a compromise around tariff rollbacks around the failed deal in May. Basically, all tariffs after that deal would be rolled back, and then earlier ones taken off too. But the bigger story on the day, because not a lot of reaction to those trade headlines, David, retail. Take a look at the weakness that we have for the likes of Kohl's, Macy's, Home Depot. This is a story that we were talking about last week, David, through Cisco. Cisco cut their outlook twice in a row, very similar to Kohl's and also to Home Depot. Seemingly different companies, but in the real world, these different sectors are all part of one flow. The consumer beneath really showing signs of weakness. Something to keep an eye on. Everybody's thinking about trade, but we're now seeing these continuing signs of weakness around the U.S. consumer. It'll be interesting to see if and when that starts to really eat into these record highs for stocks. But on the day, mixed picture, but another round of record highs, David.
Yeah, but a weaker consumer, as you say, is not something we need. Thanks so much to Abigail Doolittle. We're going to turn now to Mark Crumpton for Bloomberg First Word News.
David, thank you. As our Kevin Cirilli was telling us, national security official Alexander Vindman is on Capitol Hill today for week 2 of the impeachment inquiry. In testimony, he said he viewed President Trump's request for an investigation into political rivals as a demand, claiming that there was, quote, a power disparity between the two leaders.
The culture I come from, the military culture, when a senior asks you to do something, even if it's polite and pleasant, it's not to be taken as a request. It's to be taken as an order. In this case, the power disparity between the two leaders, my impression is that in order to get the White House meeting, President Zelensky would have to deliver these investigations.
Vindman says he reported his concerns about the infamous July 25th call to the proper authorities in the chain of command. Ousted Bolivian President Evo Morales tells Bloomberg the country's rightful president is a senator from his majority Socialist Party. Instead, the interim leader is Janine Áñez, whose claim has been recognized by both the United States and Brazil. In Mexico, we asked Morales if he has any contact with the government.
I don't have any channel. As far as I know, the only communication is between legislators and legislators from the right wing that took part in the coup. They do have contact in order to set some rules, probably.
Bolivia has been in turmoil since opponents accused Morales of trying to rig last month's presidential vote. He quit November 10th, saying he's the victim of a right-wing coup. Democratic presidential contender Elizabeth Warren is calling out Blackstone. She says the investment firm is, quote, shamelessly profiting from the 2008 housing crisis. Warren assailed Blackstone for buying up houses and apartments in foreclosure. Blackstone says it began buying houses in 2012 after the crisis abated. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David, back to you in Washington.
Thanks so much, Mark. Coming up, SEC Chairman Jay Clayton on the shift to private markets, the risks of investing in Chinese companies, and more. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and radio. I'm David Weston. We've seen big changes in financial markets in recent years toward private capital and toward investing in companies overseas. I spoke to SEC Chairman Jay Clayton about this earlier today and what those changes might mean for U.S. regulation.
There has been a substantial shift in where capital is raised, where capital is invested from the public markets to the private markets. And I think it's been more noticeable since 2008, but it's been going on for, I'd say, about 20 years. What does it mean for the overall economy? I don't think it's having a real effect on the overall economy. In fact, the nimble nature of our private markets is often cited by people as a way that we've driven innovation and driven investment. The question for us as regulators is, given that change, are we still giving investment opportunities to our Main Street investors to the same extent that we did 20 and 30 years ago? And can we improve that?
Opportunities, but also are there risks as well?
Absolutely.
Because a lot of the regulatory structure was based on public disclosure of public companies. If they're not public companies, you might not have the information you need.
So you make an incredibly important point. And can I go a little deeper into that? So the process of becoming a public company is a fairly rigorous process. I've never seen a company go through it that didn't come out a better company. In addition, our public markets do something that's not recognized, but fundamental. Institutional investors and retail investors are side by side getting the same deal. So you have a lot of regulatory protection, then you have a lot of protection in that as a retail investor, you're getting the same deal as an institutional investor, or at least very close to the same deal. Now, our private markets do not operate that way today. Retail investors have very little access to our private markets, and where you do see access, you're not sure that there's that alignment of interest. So if we're going to give retail investors private market opportunities, we got to make sure we have that investor protection and that alignment of interest.
So how would that work? Because I think you have talked about the possibility of retail investors participating in private equity, for example. How could you have the disclosure requirements that would protect them and put them on equal footing?
Well, I don't think you're going to have this. If you have the disclosure requirements, then they may as well be public companies. Okay, so, but what can we do in terms of investor protection and alignment of interest that puts private investors in a place where they're getting the same deal as the long-term institutional money in the marketplace? That's the question we're asking, and we're looking for a solution. One thing may be a fund structure where you're sitting side by side with long-term sophisticated investors getting the same deal, but we're open. We're just recognizing that the landscape has changed, and if I take a look at the 401k of an individual investor, that 401k does not look like a well-managed pension fund. A well-managed pension fund is going to have a fair amount, a range depending on the fund, allocated to private investments, because that's where growth is, that's where returns are. It shouldn't have it all, Well, diversification is extremely important, but there's a delta there. There's a difference between what a individually managed 401k looks like and what a well-managed pension fund looks like. Maybe that's fine, but we should be asking ourselves that question. And
that's one of the shifts we've seen for retail investors into ETFs, into index funds and things like that, which would give them more protection as a practical matter. Also might limit their reward as a practical matter. Is there a risk to society if individual retail investors are free to take the bigger risk, because actually they can end up on the dole, as it were? Social Security is not enough to support them. This is their pension now.
Let me be clear about this. Indexation, diversification, they're extremely important investment tools for individual investors. We encourage people to diversify, to use low-cost index products. 40 years ago, getting broad exposure to the marketplace was costly for an individual investor. Today, it's almost costless. That's a wonderful thing. I don't want to do anything to impact that, but I do look at what's going on in individual retirement accounts, and I look at well-managed pension funds, and I see well-managed pension funds have a lot of exposure to our private markets, which last year raised more capital than our public markets, and say, is there something that we should be doing? Is there some portion of that individual investors should have the choice to invest in? But investor protection at the SEC is paramount.
Another big shift we've seen is the extent to which U.S. investors are investing in overseas companies. In particular, let's talk about China, for one. That's very much in the news right now. We don't always know that we can trust the numbers, the audited numbers of Chinese companies. What can the U.S. do about that? What should it do?
Well, you raise a very important. We have a great system. I mean, look, every system has flaws. Every system has bad actors. We're trying to eliminate the flaws. We're trying to get rid of the bad actors. But on a comparative basis to other countries and how they regulate their capital markets, far superior, far more investor protection, far more transparency. Now, some may say I'm, too much waving the flag, but that's true. And investors should recognize that. As you go to other markets, you do not have the same protections that you have here in the U.S. So I want people to understand that. Doesn't mean we should foreclose those opportunities because, there's clearly growth in places outside the United States. There are clearly good investment opportunities. And there are clearly good companies. But investing overseas is different from investing in the U.S.
One of the things that protects an investor here, for example, is 10b-5, your rule 10b-5 against misleading or fraudulent statements. Does that apply to a Chinese company? If I invest in a U.S. capital market in a large Chinese company, can I sue them under 10b-5?
So there's a big difference between what the law says you can do and what you can do in practice. Now, here we have a system built up over time that if somebody commits fraud, there is a way to get redress. If a company commits fraud, you bring an action, we would bring an action, other regulators bring an action. Look across the spectrum and see to the extent to which that happens outside the United States, it's less. And people should, even if the law says the same thing, what actually happens in practice? I mean, I think people who manage companies in the United States know people are watching. And that's important. They should know people are watching.
One of the things that you and the SEC have gotten a lot of attention for in recent days is a new proposed regulation on proxy advice, as well as a related, perhaps, proposed regulation on shareholder initiatives. How would the proposal on the proxy advice differ from what current law is?
On proxy advice?
Yeah, exactly.
Look, let me just speak broadly, because this is a proposal out there. The shareholder engagement arena is very important. Like I said, managers should know their shareholders are watching. They should know that their shareholders are going to hold them accountable for the decisions they make. That's an important part of our system. But that system needs in itself to be transparent, and it needs to be accurate. And what we're looking to do is modernize our rules around the proxy process to ensure that people who are, for example, relying on proxy advisors know whether those proxy advisors have conflicts. And, whether the information that they're putting out is accurate. Now, it's a proposal. We welcome comment. These rules have not been updated for a long time. Our markets have changed dramatically. We've had a shift from direct investment to investment through funds. We've had a shift to proxy advisors, giving a lot of advice to people who manage funds and others. And we want to hear from people. How can we improve and modernize this system?
That was my interview with SEC Chairman Jay Clayton. Still ahead, Kohl's gets crushed. Why the company is having its worst day since 2017. It's our Stock of the Hour. That's next, and this is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Time now for the Stock of the Hour. Kohl's is heading for its worst day since January of 2017, plunging more than 17% after the retailer cut its full-year earnings view for the second time this year. Kaylee Lyons is in New York with the story. So, Kaylee, what happened?
Well, starting with what happened in the third quarter, the print was just really quite ugly. They missed on earnings by a pretty wide margin. They came in at just 74 cents. That was about 12 cents shy than what the street was looking for. And also, comp sales grew at essentially half the pace what analysts were expecting. They only rose about 0.4%. And then, as you said, David, they did cut that full-year earnings guidance yet again for the second time. This time it was a pretty hefty lob off the top end. They now see at the high end, it'll only be as high as $4.95 a share. They'd previously seen as high as $5.45. So a pretty big cut there. The company placing blame on the one hand, the fact that demand for women's apparel just really is kind of lagging. And then, of course, we have to keep in mind when we think about the bottom line for Kohl's that about a fifth of their products come from China. As we know, there's been a series of tariffs that have added more than $1 billion in cost to the company. So that is putting some pressure on the margin, as is some of the other investments the company is making. They're making a lot of investments to attract millennials into their stores to try and lift those same store sales. And then, as we know, Kohl's has been interacting a lot with partnerships. They have a partnership with Weight Watchers, for example, and then also with Amazon, which is a really big focal point from them. That partnership essentially allows customers to return packages from Amazon to Kohl's stores in about 1,000 different locations. The thesis being that when they return those packages, they're then going to go into Kohl's, shop around, look at the aisles, and maybe make a purchase. Now, that said, to this point, it doesn't seem like that's paying off in a huge way with the weakness that we're seeing. But on the call, management did say they expect it to be a positive addition to operating income in 2019. But when you look at that sales number, David, essentially you're just seeing this reverberate throughout the retail sector. Today, the retailing index is off by about 1.5% because the fact that the weakness is on sales doesn't necessarily bode well going into the holiday quarter, which, as we know, is crucial for all of these names. And that's really dragging on some department store peers like Macy's and Nordstrom's today as well.
Yeah, of course, we look at Kohl's both for its own sake, but also what it might tell us more broadly about retail and, more broadly than that, the consumer. As I recall, when the retail sales numbers came out, apparel did not grow as much as other places did. So is this an apparel problem? Is this a Kohl's problem? Or could it be a broader consumer problem developing?
I think it could be both, as you alluded to. When we saw retail sales data come out last week, 7 of the 13 sectors were down. So that points to a broader consumer problem, a little bit of a softening there. But clothing and apparel sales were weak, as was furniture, which also brings me more into the housing space, David, and Home Depot. As we know, Home Depot also reported this morning that often seen as kind of a bellwether on the health of the consumer and housing sector. And they did miss on comps sales for the third quarter in a row and cut their guidance also for a second time this year. They only see comps rising about 3.5% for the full fiscal year. But interesting, David, the company says that is because they've made a lot of investments in online. They haven't necessarily been paying off. It's been slow to see that payoff. Right. And on the call, the executive said that they don't see any big macro environment concerns here. It seems to be more execution related.
Kayleigh, I want to sneak in one more, which is what about the discount guys? What about TJ Maxx?
It is the one bright spot in retail today. The stock is actually up, even if it's just marginally, only actually now about 2.4%. Really strong third quarter from them. And that just goes to show you, David, that the type of retailer you are really seems to matter. And those discount differentiated retailers seem to be performing a little bit better in this environment.
Okay, Kayleigh Lines, thank you so much for that survey of retail and the consumer. Really appreciate it. Up next, Democratic presidential candidates Bernie Sanders and Elizabeth Warren have embraced Medicare for all. But would it work in practice? And are voters going to buy into the plans? We discuss that next. This is Balance of Power on Bloomberg Television and on radio. From Washington, this is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we're going to go now to Mark Crumpton in New York.
David, protesters set to continue in Hong Kong with demonstrators planning to block roads and disrupt rail services. Authorities say they fired more than 1,400 volleys of tear gas during battles with protesters that left streets strewn with debris. This as hospitals are overwhelmed with injured demonstrators evacuated from a university campus standoff with police overnight. The city's leader is urging a peaceful end to the showdown. Anti-government protests in Iran are posing a question. Is the Trump administration's campaign of maximum pressure starting to work? Demonstrations began last week when Tehran raised the price of gasoline. That led to buses and banks being burned, the internet blocked, and a number of people killed. Tensions in Iran have risen since the U.S. pulled out of the landmark 2015 nuclear deal and reimposed economic sanctions. President Trump says he protested U.S. interest rates during a meeting with Fed Chair Jerome Powell. The two were at the White House on Monday, along with Treasury Secretary Steven Mnuchin. The president has constantly criticized Chairman Powell. He said U.S. rates are too high relative to other developed nations. The world's biggest diamond mine, famed for the coveted pink diamonds and red gems it yields annually, is closing. After almost 4 decades of operation, multinational Rio Tinto is closing down the Western Australian mine on Thursday. It was home to about 90% of the world's prized pink diamonds, but has recently seen its supply of economically viable jewels exhausted. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David, back to you in Washington.
Thanks so much, Mark. 10 Democratic presidential candidates are going to take the stage tomorrow night in Atlanta, and a lot has changed since the last time they had a debate. But one thing has not changed. Still, one of the biggest issues dominating the debates and the entire race is health care policy. Our next guest is an expert in health care economics and has been critical of Medicare for All, saying it could lead to tax increases and cuts to services. Welcome now, Catherine Baker, professor at the University of Chicago, back to Bloomberg. So, Dr. Baker, thank you so much for being here. You have a paper out today, which I found fascinating, because as I understood it, it was not so much how do you pay for it, but can you really have one size fits all in our society today?
That's a key question. Having a really generous Medicare program may fit the needs of high-income populations, but not the needs of low-income populations, because there's so much money that we could spend on health care that it may crowd out other things like assistance for food or housing or other things that are really important to families.
So ironically, it could benefit the somewhat wealthier in society and actually have a disbenefit to people who are more in need. What would be a more sensible approach?
The key question we should be asking is how much health care should be provided to everyone? And people may have different answers to that question, but if you provided something that looked more like Medicaid for all, that would leave more money available for other things. If you provide a really generous benefit like Medicare for all, that would require much higher taxes and would leave much less money for other priorities, and that may not fit people's needs.
So let's emphasize that distinction between Medicare and Medicaid. We think of Medicaid as being for the less fortunate among us, Medicare, of course, being for the elderly among us. How different are those two programs? How much richer is the Medicare than the Medicaid?
That's a key question. There's a question of how much is covered. What services are covered? Should we cover services that have very minimal health benefits or only services that really improve health? There's a question of how much providers are paid through each program, and that'll affect how much care is actually available to people. So, for example, a Medicare for All program that covers a wide array of benefits would lead to a lot more demand for health care for people who didn't have insurance before. If you pay for that by cutting back on payments to doctors and hospitals, that's going to restrict the availability of supply, and you're going to have shortages. Whereas if you had a program that covered fewer services but with more generous payments, that might make sure that there was enough health care available for people who were in the program, but keep it more affordable. And in general, Medicaid pays less than Medicare, but also covers less than Medicare.
We're talking with Professor Catherine Baker of the University of Chicago about health care. And let's talk about what a different alternative might be, which is Affordable Care Act, that is Obamacare perhaps enhanced. We talked recently with Speaker of the House Nancy Pelosi, and she said that she would prefer an approach like that to Medicare for All. This is what she said.
I'm not a big fan of Medicare for All. I mean, I welcome the debate. I think that we should have health care for all. I think that the Affordable Care benefit is better than the Medicare benefit.
So does she have a point from your point of view, Dr. Baker? Would it be better to take Affordable Care Act and enhance it?
She has a great point in that we really need to consider how much health care we want to provide to people and via what mechanism. The problem with Medicare for All is that it's a uniform benefit that covers a lot of services, which means providing it to everyone would be really expensive. Having people be able to opt into a plan that they find appealing, that could work out well, except you have to think really hard about which people are going to opt in and what kind of risk pool that leaves in private markets. So a plan that makes sure that private markets still function robustly and that people have choices might steer us towards higher value health care than we're getting from the system right now.
Well, so let's go back to Medicare for All for a moment. What would that make of the private provision of health care services, for that matter, insurance as well? Can you have Medicare for All and still maintain a substantial private element in the system?
I think definitionally not. The idea behind Medicare for All is that you roll everyone who's getting private insurance into the government-run Medicare plan. And that is the way most people get their insurance now, is through an employer-sponsored plan. Under an expansive Medicare for All proposal, that would go away, and all of the resources that go into the private market would be rolled into the government plan. Plus, I think a lot more would need to be raised through taxes, because when you give people a really generous health insurance benefit, they're going to use more care, and somebody's going to have to pay for that.
So one of the things we've heard from former Vice President Biden, as well as from Mayor Pete Buttigieg, is the possibility of a private option, whether there should be an option added into the Affordable Care Act. Does that make sense to you?
The challenge with a private option, with a public option competing with private plans, is making sure that you have a public option that's competing with private plans on a level playing field. That's challenging when the government is running one of the plans. So the question we need to figure out is, how much would the government be paying for services? Right now, Medicare pays about half of what private insurers pay to doctors or hospitals for given services. What would a public option pay? How much would people pay to enroll in it? And if they wouldn't pay anything, would disproportionately sick people choose to enroll in it? It's not clear that a public plan could really compete with private plans on a level playing field. And those questions I don't think have been resolved. But one important thing to add is having health insurance is really valuable to people. So none of this debate should take away from the fact that uninsured people need more access to health care. The question is just how to do it in a way that's financially sustainable.
So finally, Professor Baker, I always ask you a version of this question, but I want to ask it again. If we were solving the entire equation for one thing, and that is bending the cost curve, we now have 17 or 18% of GDP attributed to healthcare. It's going up. Most people think that's not sustainable. If the one thing we're trying to solve is that, what's the best approach?
I don't think it's Medicare for all. I think we would end up spending a lot more money with Medicare for all. I think a better approach would be to guarantee a benefit package for everyone that covered all high-value services, but didn't cover those services with questionable health benefits. That would keep our spending from rising as quickly and would ensure that what we're spending is really valuable for people's health. So a more basic benefit available to everyone, and then giving people the option to buy more coverage of less beneficial services if they wanted to. I think that would bend the curve.
Okay, many thanks to Dr. Catherine Baker of the University of Chicago, professor there. Thanks. Always great to have you with us, Catherine. Coming up, we talk with legendary emerging markets investor Mark Mobius about the crisis in Hong Kong. Meanwhile, Senator Jim Risch, the chairman of the Foreign Relations Committee, has just said that the Senate is going to vote on its Hong Kong bill at 5 p.m. Eastern today. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Protests continue in Hong Kong. I spoke with Mobius Capital Partners partner and co-founder Mark Mobius earlier today about the embattled city and whether the U.S. is taking the right approach to the issue right now.
I think it's the only approach the U.S. can take, because at the end of the day, the U.S. says, look, we stand for freedom, democracy, rule of law, and so forth. And you must remember, Hong Kong is very critical to U.S. investors. We have a lot of investments in Hong Kong in order to get into China. So I believe that it's very, very critical in that regard. I'm not saying what the U.S. Congress is doing may be the right approach, but I believe it's really the only thing they can do. They've got to react to what's happening in Hong Kong.
Doesn't this pose a real conflict, though, between Beijing and Washington? It's critical on Capitol Hill. At the same time, it's clear that President Xi regards this as a matter of sovereignty. Maybe two systems, but it's one country. And he keeps saying, this is our business, not your business.
Yes, but you must remember that the law, the U.S. law, did specify that the Hong Kong had to be free of Chinese influence during the time that this law would be in place. So I think there's probably no real choice on the part of the U.S. other than to abrogate the law, which would have tremendous implications for trade with Hong Kong.
You know China so well. You know Asia terribly well, China terribly well. What do you make of the Trump administration approach to China more broadly with their trade initiatives, but also now we're seeing military activities once again in the South China Sea? Are they doing it the right way?
I think there really is no choice because, as you know, China has become much more aggressive in the South China Sea, in expanding globally, in showing the military might. And you have a situation where the U.S. has been the hegemon, so to speak, for the globe. And now you have this big competitor coming into play. And I think there really is no choice for the U.S. but to respond at the end of the day, because otherwise you're going to have the options open to American trade and other aspects threatened. For example, you just take the South China Sea. If those routes going from the Middle East to Japan are interrupted in any way, going through the South China Sea, then you've got a real strategic issue.
President Trump is, I think it's fair to say, a divisive figure in the United States. People love him or people really don't like him much at all. You travel a lot around the world, constantly. How is President Trump perceived overseas?
It's interesting. The perception overseas often is not as negative as you would find in the U.S. Very often you find people who like his approach, like his strong approach, like the fact that he's looking after America. It's kind of ironic because you'd think people would say, hey, he's ignoring us, and now he's just looking at America. But America is sort of a symbol of strength for a lot of people, and they would like to see a strong America. And the degree to which Trump is perceived as enhancing the strength of America is seen as positive by many people.
You've had a distinguished and very successful career investing over the long term in emerging markets. Are investments in emerging markets better or worse under Donald Trump than before?
At this stage of the game, they're somewhat better. The reasons I just mentioned. The U.S. is strong, and if the U.S. market is strong, emerging markets have a chance to come up as well, which is what's happened. So, and the interesting thing is that a lot of people see the U.S. has had too long of a bull market and may be slowing down. Therefore, some of the money that's been earned in the U.S. market may move into, or already is moving into, emerging markets.
How much of the strength of the United States and its economy is due to the Fed and monetary policy? We've had reports just yesterday President Trump met with Jay Powell, the chair of the Fed, talked about things such as, for example, negative interest rates. How much of it is actually because of a steady hand at the Fed?
It's a really interesting question because I believe central banks around the world, including the Fed, have got it wrong. I mean, the fact that they're focusing on trying to get 2% inflation, to me, is like pushing on a string, because productivity is rising at such a fast pace as a result of computerization, internet, and so forth. Prices are going down. So it's very, very difficult to achieve that happy 2% inflation. And by pumping money into the economy, it doesn't really have the desired effect. And it's somewhat dangerous in a way, because now we're in a situation where it's very difficult to assess the value of equities or any other asset that you have, because with free money, how do you measure?
How do you weigh the two possible effects of free money, essentially very, very low interest rates? On the one hand, it could encourage investment, which would drive productivity even higher, a good thing. On the other hand, it could just drive asset values up. You're an investor. Are asset values too high now, in part because of money being so cheap?
That's one of the big problems. I remember the days when we used to buy stocks at 5 times PE ratios. Now 20, 30 is nothing. It's common because of these extremely low interest rates. And that's what I mean when I say it's getting more and more difficult to assess assets, because you've got a situation where almost zero interest rates doesn't give you any kind of measure of where you're going.
So it gives you access to capital as a practical matter, but how do you find opportunities in this world? I mean, you've been famous for many years of finding opportunities where no one else is looking, essentially. Where are you looking right now where there are opportunities?
What I do is I look at companies that, number one, have a good return on assets, good return on capital. That's number one. Number two, I look at companies who pay dividends. Not only because I'd like to get some yield, because you're not getting any yield at the bank, but also it shows that the company has some reasonably good corporate governance. So I would say those two factors are most important.
Geopolitical stability also helps when you're investing overseas. Right now, we've got apparently a lot of instability. It's not just Hong Kong. We have it in Chile. We have it in Bolivia. We even have it in Iran. We have it around the world. How do you find geopolitical stability to backstop your investments in emerging markets?
I think as a result of the internet and a result of this communications revolution, you're going to see a lot more turmoil in these countries, but you've got to take it in stride. Yes, if you have violent turmoil like you're now seeing in Hong Kong, it's bad. But if you have peaceful demonstrations which result in more honest governments, less corruption, then it's very good for us as investors.
What areas around the world do you like right now? What's at the top of your list in terms of emerging markets?
I would say India is right up there. China, of course, still important. Brazil has done very well recently, and now we think with reforms coming in, it'll do better. And Russia, it's amazing the way Russia has performed. So the BRICS still look pretty good. And then further afield, we're looking at some of the Southeast Asian countries like Indonesia, Malaysia, Thailand, Philippines. Of course, Vietnam has done very well. And then in Europe, or near Europe, Turkey is a place to look. And then in Africa, I would say South Africa could become looking pretty good if Ramaphosa is able to get some of the reforms.
That was my interview with Mark Mobius. He's co-founder and partner in Mobius Capital Partners. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and radio. I'm David Weston. The securities industry gathers in Washington today, and one of the questions for it is what if the election year may mean for regulation of the financial markets? I spoke with Ken Bentsen. He's Securities Industry and Financial Markets Association President and CEO at the trade group's annual meeting earlier today.
We're a highly regulated industry. We were before Dodd-Frank. We will be after Dodd-Frank. And so those issues kind of keep coming, and they bubble up to the top. And then we have issues coming from Europe, like MiFID II, that we're having to address. And then we have changes in the industry. I think on the political issues, those are starting to seep in a little bit. But I think that's probably something we'll look at as we go into the next year. But it's certainly a topic of conversation.
As you gather here and talk about the various issues specifically related to the securities industry, how do you take into account the larger issues, such as, for example, trade, whether it's U.S.-China trade or USMCA, things like monetary policy? We saw President Trump meeting with Jay Clayton yesterday. How do you take that into account for your industry?
Well, it's a good question. We had Senator Tim Scott from South Carolina yesterday, and we talked a little bit about the USMCA, the NAFTA 2.0, which we strongly support and is, I think, an important piece of legislation, trade legislation. We're hopeful Congress can get that done because, while it's not specific to financial services in all respects, it is in some, but it also has broader economic impacts that impact the market. So we'd like to see that done. Likewise, on China, we've been working for many years to gain better market access for U.S. firms operating in China in the securities business. And China's made steps in that direction to give majority ownership, which we think is important, but not much has happened. That's now been thrust forward into the debate. So we're optimistic in this, I think phase one is what it's called, of this U.S.-China agreement that would include moving forward on the financial services. So again, that's very important as well.
Does your industry take positions on, for example, some of the initiatives with respect to auditing of Chinese companies who trade their securities in the United States? As you know, there's a move afoot to say we really have to look at that because we can't rely upon the numbers we're getting out of China.
It's something we haven't gotten directly involved in that. We certainly have watched the legislation that's unfolded that Senator Rubio and others have put forth, and it's something that, from a corporate finance perspective, we're taking a look at, but we haven't weighed in at this point.
Is it a risk to the industry, the securities industry, the possibility of sort of a disentanglement, as it were, of the capital markets in China and the United States?
Well, I think I think we want to expand the entanglement, if you will, of the capital markets between the two countries. And in fact, we would argue that it's to the benefit of the Chinese economy to have more direct foreign investment and a broader capital market system. We think they're too bank dependent over there, and for their own growth benefits, they need a broader capital market system. Likewise, that benefits the broader global economy by having a moving forward China. So we think there's a benefit of engagement.
That was part of my conversation earlier today with Ken Bentsen. He is the president and the CEO of SIFMA, which is gathering for its annual meeting as we speak here in Washington. Coming up, Balance of Power continues on Bloomberg Radio. In our second hour, we're going to take a look at impeachment and specifically talk with Bloomberg opinion columnist Ramesh Ponnuru. He has a piece out about 3 basic mistakes that are being made on the subject of impeachment. Live from Washington, our bureau here, this is Balance of Power, and we are on Bloomberg Television and we are on Bloomberg Radio.